Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. I'm also here with Andrew Brown, our intern from the University of Tennessee. How are you guys doing?
Great. How's it going, Gary?
All right. How was your weekend, Rob?
Can't complain. Can't complain. Getting back in the swing of things. Always good to start the Monday off with the five things version. Great to have Andrew back too. I think it's been a little bit. We've had Alex show up a couple of times here contributing. I think we need to get Andrew his fun, unique title like we gave Alex last time too.
Yeah, we're going to work on it. Andrew, when are you back in school?
I start back a week from today, so it's good to be back on the five things. Nice to see you guys.
All right. Glad to
Great
have
to
you
have you,
here.
Andrew.
Thank
Gary,
you.
before we jump into this week's issue, we got some exciting news actually coming up. DKI is about to release here within, I think, the next week or two, new research on a new position that DKI will be taking up. Gary, give me your 60-second elevator pitch on why people should care about this new report.
Sure, Rob. At the end of last year, working with our medical advisors and physicians on the board of advisors at DKI, we invested in Shockwave Medical. We bought that stock in December at 191 on the thesis they'd be acquired. The company was bought 3.5, 4 months later for 335. Our subscribers made more than 70% in under 4 months. We found a new stock that is very similar, and that's a great way to find investment ideas. You look for similarities in the situation. Working with the same physicians, the same medical advisors, or same members of the board of advisors, we've uncovered another single product medical device or drug company, extremely high growth. The upside here is we get better patient outcomes, and it saves the insurance companies or Medicare or Medicaid 75%. We think in this stock, there's the opportunity to make something like 4 to 5 times your money in the next 3 to 5 years. We think it's another takeover candidate. We think it looks a lot like Shockwave Medical. We're only going to be releasing this to premium subscribers. So if that's of interest to you, we'd love to have you join us. Just go to the website, deepknowledgeinvesting.com, click on the subscribe now button, and we'd love to be talking to you about this new stock opportunity.
Great to hear, Gary. We'll keep everyone in tune. And as mentioned, that report will only be made available to Deep Knowledge Investing premium subscribers. So be sure to grab a premium subscription to get on our mailing list to receive that report. And similarly, like you mentioned with Shockwave, exited that position. Only premium subscribers are going to know, one, when we initiate a new position, and two, and more importantly, also when we exit and close out that position, which obviously the Shockwave position has now been closed with that acquisition. So be sure to go on our website, click that subscribe now button, or shoot us an email if you have any questions or any issues becoming a premium subscriber. This week's edition of the five things we're calling the "We Don't Have Your Data" issue. The nice part too is we only have 5, so I don't think we need to rebrand this segment after a few bonus points the last couple of weeks. We're talking authID, DKI portfolio company back in the news this week. We're looking at Treasury auctions. We talked a little bit in the past. Talking about Japan carry trade, right, Gary? You touched on that a little bit last week when we kind of had that volatility over the weekend and into Monday of this past week. And then also higher CPI. Talking Arthur Burns makes another appearance here in this week's five things. Andrew, Gary, ready to rock and roll?
Let's go.
All righty. Thing number 1, we're talking authID. Ticker is AUID. authID reports second quarter and unveils new technology. Tell us more about that, Gary.
So great quarter from authID. This is a company that did a little under, right around $200,000 of revenue last year. They did almost that much in the first quarter, and then in the second quarter, $280,000. So they're now putting up more revenue in an individual quarter than they were in all of last year. The company reaffirmed all guidance, saying everything's good, we're in good shape. authID also provided a comprehensive list of new reseller and partner agreements. The team there has done a great job of getting their biometric authentication solution on a whole bunch of platforms, and that will take some of the pressure off the sales force to bring in some new customers and clients over time. More importantly, the company was able to install and scale their best in class and fastest in the market biometric authentication product at multiple new and growing customer accounts. You know, something like that, Rob, is a really big deal. When you are a startup tech company, you have something that typically works, you know, in the lab or in tests, but it can be very difficult to install these things, to get it working on somebody else's platform, and then to have it scale instead of having it work in one or two examples. What happens when, you know, you're starting to run 70, 80,000 authentications a month or 500,000 a month? And that's the direction they're heading. The team there worked very hard to get that done. And it's very clear from guidance based on the relationships they have and the customers that they've got scaled, that the revenue growth rate is going to increase from here. They're talking about, so they did $280,000 last quarter. They're talking about doing another $1 million in revenue over the next 2 quarters. So they're basically going to double this run rate. It'll be up in the third quarter, up again in the fourth quarter. So don't look for $500,000 next quarter. You'll get somewhere north of 280, and then the remainder of it more than $500,000 in the fourth quarter. I think all of that is really encouraging. And then the big news, Rob, was CEO Rhonda Guro previously teased this incredible technology on a webinar that he did with Deep Knowledge Investing a couple months ago. It's called Zero Biometrics. And so the key thing with Zero Biometrics is one thing that concerns people is right now you use a username and password to protect your data, your customer information, whether it's your phone number, your name, your address, your credit card number, your social security number. So when you switch to using biometrics to protect your data, what you can end up doing if you don't do it well, and this is what everybody but authID is doing, you end up with a database. Instead of a database of people's names and social security numbers and phone numbers and account numbers, you end up with a database of their biometric data. And that can be hacked. It's another vector for fraud. Well, Zero Biometrics, authID is the only company with access to their technology. And what it does is it ensures there's a public key, private key exchange, and there's a new public key every time there's an authentication. And what that means is the company does not store any biometric data. So what isn't stored can't be stolen by fraudsters. Basically, what I'm telling you is authID now has the most accurate technology in the industry. They make a mistake 1 in a billion times. So if they were to authenticate everyone on the planet, they'd be wrong 8 times and right, well, you know, 8 billion less 8. They have the best user interface in the business. They have the fastest authentication. Right now, they're at 0.7 seconds, aiming for 0.4 seconds. And they right now have the most secure solution in the business.
Gary, I want to hone in on that Zero Biometrics piece a little bit because I think that's a big differentiator. I actually worked at a tech startup, and the issue we were trying to solve early days was a lot of times the network is secured, right? But then when hackers do gain access into the network itself, the data and the information is in plain sight. So it becomes very easy for them to obviously grab that data and leave. We were working actually as cryptographic bit splitting at the time, to where not only were you encrypting obviously your network, but then you were also encrypting the data and the information at the root, right? The file itself. Sounds like with the public private key technology that authID is providing something similar, or at least you're having to have that unique key to be able to access that data and information at any given time, which more or less ensures that, okay, if there was some sort of breach, you're going to open the vault and nothing is inside.
Rob, you got it nailed. You understand this perfectly. So basically the 2 key points here is, one, everybody has this picture in their head that when the hackers, when the fraudsters, when they gain access to your system, it's kind of like that war game scenario, you know, where somebody's hacking in through a back door, you figure out like the secret code. That can happen, but most of the time, the authorization, the access is actually provided by the system because the fraudster is impersonating somebody. The fraudster finds a way to impersonate somebody who has access and then gets that access. And so the key thing that authID does here is they authenticate the person, not the device. Other people's systems often authenticate the device. So, for instance, we all think about, your cell phone. And if you have the right fingerprint or face ID or password, you can then get access to a cell phone, and that enables you to access all of the apps. Basically, the apps say, okay, that's Gary's cell phone. So we recognize this must be Gary. It may not be, right? But they're authenticating the device. And what authID does is they say the real vector for fraud is impersonating somebody who should have access. So instead of allowing that, we're going to use biometrics to stop it. And when that happens, you're authenticating the person. So right now, if the bad guy has your device and can have access to it, they can access a lot of your data, a lot of your accounts. With authID, the bad guy can have your device, it won't matter. They authenticate you, and that is a huge difference. And by not storing your biometric data, by not having it, the company doesn't even have access to it.
Right.
One of the things we've seen with some of the cell phone companies where they've talked about security, and like, the FBI or the CIA has gone to them and said, hey, can you get us access to this person's cell phone? And sometimes they've said, we don't have it. We don't have that access. We can't provide it. We can't provide that data. Now, there have been times that's been true and times it's been a lie, but in the case of authID, you can't hack what doesn't exist. And that's why this public key, private key technology is such a game changer. And, from a sales point of view, and because sales, that is the next thing that authID is going to have to do for the stock to work. And I have confidence that they will. I have confidence in Ron DeGuro, the CEO, and the sales team there. But try to imagine, going into like one of the largest banks in the world, or places where security really matters, or working like with a casino, something like that, where again, the bad guys, if they get into your system, they can create huge amounts of trouble. And now go to them and say, hey, we have a system that ensures that this data cannot be hacked. It cannot be stolen. This changes the sales landscape as well as the technology landscape. So, I was obviously very enthusiastic and bullish about authID from the beginning. This is a situation where, we took a position, and over time, as the risk has come out and the technology has gotten better, I've actually bought more of the stock myself.
Yeah, one of the things to mention on that, current recommendations have also been updated on the website for premium subscribers. Gary's added some weighting to that particular page to help just understand what kind of portfolio positioning looks like, and be sure to check out what that weighting looks like on the authID ticker. Moving to thing number 2, Gary, we're going to bring Andrew. You guys will tackle this one. Thing number 2, trading platform outages. Tell us more about it.
All right, Andrew, what's going on there?
Yeah, so last Monday, as you guys all know, there was a lot of market volatility. Everyone had a really volatile day in the market. And overall, it was very volatile, but there's been times in the past that have been a much more severe crash, let's per se. And so last Monday morning, I was logging into my brokerage account on my phone, which is Charles Schwab, and I came to realize I can't log into my account. And I thought, okay, there's just some password thing, but I'm typing in the right password. So after about an hour, I forgot about it, came back, tried to log in again, and I still can't log into my account. And the market's going crazy, and I just want to see what's going on with my portfolio. And I come to the conclusion, all right, something's up. So I start searching on Google and X, and I find out that there's been an outage in Charles Schwab. And then I start reading some more, and there's been some outages across the whole industry. So like Robinhood, Fidelity, Vanguard, they were all experiencing outages. And this is something that has happened before. It's happened during COVID when there was a lot of market volatility. And it's something that they haven't really fixed. And this is something that could be much worse in the future. I mean, your phone, it's just a digital asset. You can't do that. Like if things go wrong, you're locked out of your account. So the market could be absolutely tanking, and you could be locked out of your account and have no power over the value of your stock. You can't exit that position. You have nothing. You're almost worthless when it comes to that. And so if we look at this, and there's a trend historically of kind of what happened last week and what's happened before. And if we look way back to the 1920s during the Great Depression, people the banks collapsed and people stormed the banks to try to get their money, but they couldn't get their money. And so there were huge lines of people trying to get their money out of the banks and withdraw it, but they couldn't. And this could really happen in the future with something like this. If the market's absolutely tanking, you could be locked out of your phone and have no access. So that kind of comes full circle of why you really should take a look at DKI's positions and how we kind of hedge yourself against the market. And one of kind of the key things here is that gold and Bitcoin are kind of the two paths to kind of forget about this, because yes, you're always going to need some sort of stock in your portfolio, but eventually things can go south and you just kind of need a little bit of a backup. And if you have the physical asset of gold, that can protect against all of this risk. Or if you have physical self-custody of Bitcoin, and I'm sure Gary, he can talk more about kind of the whole process of self-custody. And there's also a Twitter thread that maybe Gary wants to kind of note on real quick on kind of the process of self-custody.
Yeah. So Andrew, I think you're making three crucial points here. And they're really important for people to understand. One is these systems go down and become inaccessible at times of market stress and instability. When there's a market crash, that's the time. Like you wake up on a normal Tuesday and everything's quiet and there's nothing going on. Guess what? You're going to have access to your account then.
Mm-hmm.
It's people lose access. These systems crash, they go down, you lose access at the moments when you most need to get out of positions, right? It's the excess volume. And by the way, there have been rumors, and I don't know who did what, but there have been rumors in certain situations when markets have gone crazy and people said, just shut the system down. Don't let people trade it. Or, you know, as you guys have pointed out before, in the case of GameStop, they turned off the buy button, right? We won't let you trade it. You're hurting our other clients. And so the times when you most need access, those are the times when you won't have access. So, you know, what do we do about it? Because you can't stop that, right? If you're listening to this, you don't have the power to fix that system. You don't have the power to make everybody honest or reliable or make the system robust. It's not going to happen. So what do? We have two great options for you. One is, one of the things we do at Deep Knowledge Investing is we work with our clients, our subscribers, and we help them hedge their portfolio. Now, is that a guarantee you can't lose money? Absolutely not. No, there are no guarantees, and whatever you do has risk. But what it does mean is in those moments when markets are melting down, when things are really crazy, at those moments when you are most likely to lose access to your account, you have something that will be making you money while everybody else is losing money. It means the potential losses will not be as severe, or potentially you could make money. But you're not in free fall with everybody else. Now, there's a cost to that. None of this is free, but it does protect you in those situations where the market's melting down and you can't access your positions. You have part of your portfolio making money when everybody's losing everything. The second thing that really matters here is I want people to start to think about having some assets outside the system. Now, nobody go crazy here. I'm not saying, you know, start digging holes in your yard and burying cash in it and sticking, you know, gold in your mattress or whatever. Maybe it's cash in your mattress and gold in the ground. I'm not suggesting that, you know, we all prepare for tomorrow's apocalypse. What I am suggesting is that the financial system is not 100% reliable. And just as a way to protect yourself, you should have some assets outside the system. Two easy ways to do that is to buy physical gold and hold it. Another is to own Bitcoin. But if you're going to do that, don't have it on the platforms, right? Like Coinbase can be terrific, but if the system goes down, you're not going to have access to it. So you want to self-custody. And I know that can be scary for people, but the thread that Andrew was talking about, we put up a detailed thread on Twitter or X where we explain to people how to self-custody. And we made it really simple. It's annotated. We've got pictures up, you know, fill in this box, click this button. And we have made it step-by-step possible for people to self-custody. And I understand, like, if you've never done it before, it can be nerve-wracking. There's no 800 number. You can't call 1-800-BITCOIN and ask to talk to the manager. So I get that that can be hard, but there are opportunities for all of you, for all of us, to have some money outside the system, to hedge your portfolio, to be in a position where if there is another market meltdown and you don't have access to your account, where you don't get wiped out, where you have some sort of protection. And we're really good at working with people on that exact issue. So if it's something that concerns you, reach out. We can help.
Andrew,
And
anything you would like to add to close on this point?
yeah, on the self-custody thing, we will put a link below for anyone who wants to find out and learn more about that self-custody thread.
Great.
All right. Good idea. Terrific. Andrew, before you go, just want to give you some public credit here. Andrew Brown from the University of Tennessee, Alex from Exeter. Both these guys have been doing incredible work. I fully acknowledge warmly, these guys have been doing 80% of the 5 things. They are picking topics, doing the analysis, fact checking things, doing writing, finding references, putting together the images and graphs. Andrew does an incredible job of cutting up the videos and posting everything. So much of what you guys are seeing in this show is being done by young interns who are smart young men doing a fantastic job. Andrew, excited to have you on with us. We want you on talking with us more often, but just round of applause for you and Alex doing just a fantastic job. You know, as I put in the written version of this week's 5 things, I wish I would have had, you know, yours and Alex's knowledge of finance and economics when I was your age. You guys are doing a great job. Keep it up.
Thank you. Thank you, Rob and Gary. And you guys have a great rest of your night.
All
Awesome.
right.
Thanks, Andrew.
Talk
Thank
to you
you.
tonight, Andrew.
Gary, moving to thing number 3, DKI has been warning about poor reception for Treasury auctions. A week later, we have one of the worst auctions in nearly a decade. Thing number 3, Gary, Treasury auction tails.
All right. So, Rob, what we've been talking about here is there are 2 things that are increasing the size of U.S. Treasury auctions. And just for people who aren't so familiar with this, these go on constantly. There are Treasury auctions every week. And this is how, you know, we largely finance our $35 trillion or so of notional public debt. So what's been happening is, one, the rate of debt increase has been increasing. And so the auction sizes have had to get larger as we are financing larger and larger deficits, right? Now we're adding another $1 trillion in debt every 3 or 4 months. And so every 3 or 4 months, we need to finance another $1 trillion through these Treasury auctions. That's one thing. But another thing we've been talking about a lot is Treasury Secretary Janet Yellen has been reducing the duration of the auctions. That's just a fancy way of saying, instead of issuing lots of 10-year paper or 30-year paper, she's doing more 1 and 2 year auctions. She's making the duration of the auction shorter. And the reason that matters is because then you have to refinance more often. So think about it. Let's say you need to finance $1 trillion and you do it through a 10-year auction. What that means is you don't need to roll that debt over. You don't need to refinance it for another decade. So you refinance that $1 trillion in 10 years. But now imagine that you do it in 1 year auctions. That means every year you need to refinance that $1 trillion. And so every year the size of your auctions grows and grows and grows. And that's what we're facing right now. And so we warned about that a week ago, and, you know, maybe we got lucky on the timing, maybe the analysis was good, but we unfortunately ended up with a terrible 10-year auction last week. The 10-year note yielded 3.96%, and the expected number was 3.93%. And so you might say, was that a big deal? Yeah, it is a big deal. That 3 basis point difference is called a tail. And anything in the 2, 3, 4, 5 per basis point range is enormous. To give you a sense, this was, I believe, the 3rd worst Treasury auction in the last 7 years. Credit to Zero Hedge. We have their graph up here. It's a really good, helpful graph. But when you take a look at it, what you realize is a 3 basis point tail is huge. And it's not a coincidence that these things are starting to happen more frequently. It's because our Treasury Department is trying to push through larger and larger auction sizes. And the bond market is saying, we're not so thrilled with this. There were also other statistics that mattered. Foreign bidders only showed up at 66%. The percentage of bids that was accepted was weaker. The amount still held by dealers was high. We don't have to go through all the statistics. I'm just going to tell you that 3 basis point tail wasn't the only problem with the auction. There was a lack of demand, and that's going to happen when the supply is continually increasing.
Gary, there were reports that Warren Buffett, who obviously we track just with his notoriety in the market, that he actually holds more T-bills than the Federal Reserve. What does that mean? What is Warren Buffett kind of preparing for here over the next coming months?
Well, so first of all, I don't want to pretend, I know exactly what Warren Buffett is thinking. He manages his own portfolio quite well. I'm unfortunately he's not a DKI subscriber, but maybe he should be. Um, but he's doing all right on his own.
He's doing all right.
But I think part of the issue is that Berkshire Hathaway likes to have an enormous amount of cash on hand because they'd rather hold cash than make a bad investment. And they're looking for really a limited number of outstanding investments where they can commit enormous amounts of capital. The other thing is the way that company is structured. It's structured very much as a tax avoidance, a legal tax avoidance corporation. And their companies throw off a lot of cash, which is not in many cases taxed in certain ways or distributed. And I'm not saying they don't pay taxes, but they're very good at organizing themselves to limit their tax bill. And so they keep that money. And so you'd rather buy T-bills than just keep the money in the bank. And I think that's a lot of what's going on. The thing that we thought was funny was got to give credit to the interns on this one. They noticed that Santiago Capital dubbed it QE, which stands for quantitative easing. So QE with Nebraskan characteristics, kind of making fun of, China's, they'll say we want democracy with Chinese characteristics or free markets with Chinese characteristics, which is basically to say not. But that's sort of their language. I thought it was a clever line by Santiago Capital. I don't know that weakness in the Treasury market is going to make Berkshire Hathaway sell their bonds. Again, I think their approach is we'd rather hold cash or Treasury bills than make a suboptimal investment. But it is kind of interesting that they own as much as they do.
Rolling into thing number 4, Gary, coming back to the Japan carry trade, we saw that start to unwind. You're saying there's more to go, which we know. Thing number 4, Gary, brings us to the Japan carry trade.
So this was the source of Monday's market volatility. This is what happened when Andrews, when his access to his Schwab account went down. Basically, what happened was, we've talked about this at length. Japan has kept their version of the Fed funds rate. They kept it below zero for something like 9 years and around zero for much longer. And just recently they decided to go above zero, and it was kind of funny because they picked their reference rate between 0 and a tenth of a percent. So basically 0.05%. This is like less than what people were getting in their checking accounts a couple of years ago. But we've talked about this before because of the carry trade, because the yield on the yen was so low, people were shorting it and buying US Treasury securities. And because there was so much selling pressure and the yield on the yen was so low, that the yen had plummeted. And they had gone from a couple years ago, something like 102 yen to the dollar, all the way down to 162 yen to the dollar. And so, that's a huge problem in a small island nation like Japan, which doesn't have a lot of natural resources and has to import energy. Energy gets priced in dollars. And when your currency slides 60% against the dollar, like, again, think about it. If anybody gets frustrated when you go fill your car up, now imagine another 60% against you. And that's what the Japanese were facing. So in response, the Bank of Japan raised their rates to 0.25%. And that meant it was roughly a 35 basis point, 0.35% increase over the last 4 months. And what that did was started to make the carry trade less attractive. Now, people have said the carry trade is about $20 trillion, but nobody's really sure. I don't know the exact size of it. But as the Bank of Japan increases their interest rates, it causes people to start to unwind the carry trade. So what that unwind looks like is people will sell US Treasuries. For that, they receive dollars. They then sell those dollars. They buy yen, and they use those yen to buy Japanese bonds. And so that's the reverse of the carry trade. And with all that money flowing in the other direction, the yen strengthened from, again, like 162 to the dollar. I think it went to 146. I looked earlier today, it was at 147 to the dollar. That's still pretty bad, but it's a huge improvement from the point of view of the Japanese. But that was the event that caused Monday's market meltdown and all of that volatility. It was the Bank of Japan moving rates, by not a huge amount. They just moved rates 20 basis points, 0.2%, and it caused all of this. Well, what happens if they keep going?
Gary, there's a takeaway that you mentioned in that Japan will probably keep its finger on the button, threatening to hike again. But then we've seen comments from the BOJ that current rate levels may be unstable. Seems like kind of some deliberate uncertainty. What do you make of that in terms of their pulse on the market and that uncertainty and what it means for others?
So, Rob, that's a great question. And it's something that I've been puzzling over. Originally, what it looked like the Bank of Japan was going to do is deliberately insert uncertainty in the system. And that to me made sense. And I'll explain what I mean. So again, it's the carry trade that has put so much pressure on the yen. And the carry trade where people are short the yen, long the dollar, short Japanese government bonds, long US Treasuries, that works. You have a guaranteed spread return as long as the currency doesn't move against you. And so if the Bank of Japan stays where they are and the yen stays weak, then you can make a huge amount of money in the carry trade without taking a lot of risk. But the risk that you're taking is that at any moment, the Bank of Japan could raise rates. And what that does is it strengthens the yen. And it means that you're short the thing that's going up. And you're short the thing that's going up quickly. And so my thought on this was, if you're the Bank of Japan, by deliberately inserting uncertainty into the system, you're warning the people engaging in the carry trade. You're warning the people who are short your currency, you could get hurt and you're not going to get advance notice. And, we'll let you know, but by the time you hear the news, it's already incorporated. You won't be able to cover that short at anything close to the current rate. And I thought it was a really clever way to warn the people who were shorting the yen, this is dangerous and we may hurt you without notice. Now, that made sense to me. And instead, what's actually happened here is the Bank of Japan went the other way. And there were comments from people both inside and outside the Bank of Japan. And the outsiders were people who were connected or formerly part of it. And they basically said, we don't think we're going to raise rates again this year. If we do, we'll give you a warning. I've always talked about how quirky it is that our board of governors, our Federal Reserve governors are constantly in front of microphones, right? I think last week I joked that if I wanted to have a meeting of, all the governors of the Federal Reserve, all I'd have to do is put a lectern and a microphone in front of my driveway because these guys can't resist an open microphone. The Bank of Japan has been more careful about that, but for some reason they've actually come out and tried to calm that market and tell people it's okay. We're not going to raise again this year. We'll give you warning before we do. Between the two of us, I don't really know why they were doing that. I thought from their point of view, the uncertainty was serving them better. But we'll see what happens. I think either way, they're stuck. If you keep rates where they are, the yen will continue to slide and they're going to experience inflation. If they raise rates, they can't afford it. Their debt to GDP is 260%. They'll blow out the budget, raise their interest expense. The only way they can pay for that is to print more yen. And the result of that is going to be more inflation. In my opinion, the best move for them would be to raise rates, but either way, they have a big problem.
Yeah, I think we had some bets on that 260% that are looking pretty good, if I remember correctly, a few months ago with the 5 things. But
Yeah.
We'll keep the pulse on the BOJ and the moves that they're making and how it's going to be affecting the markets here. Gary, moving to thing number 5, we talked a little earlier, CPI, Arthur Burns, actually has to do with used vehicle prices ticking back up. Gary, if we get an increase in goods inflation, Fed will be easing into higher CPI, and that's what you're saying is the Arthur Burns mistake, which you've talked about quite a bit on this show. Thing number 5, Gary, is inflation creeping back?
Right. So a little economic history. It's something we've discussed before. But if we go back to the 1960s and early, 1970s, the chairman of the Federal Reserve was a man named Arthur Burns. And the US started to have an inflation problem in the 1960s. And then President Lyndon Johnson summoned Burns to meet him at his ranch in Texas. And Johnson was a big guy with a bad temper and a bit of a bully. And as the story goes, he picked Burns up, slammed him against a wall, and told him he wanted lower rates. He wanted a hotter economy. Burns caved, lowered rates, and shortly later, we had a resurgence of inflation. And for those of us who are old enough to remember, there was horrible, horrible inflation back in the late 1970s. And the only thing that cured it was Burns was replaced by next Fed chairman, Paul Volcker, who raised the Fed funds rate to right around 20%. So all the people right now who don't like our Fed funds rate a little over 5%, try to imagine at 4 times that rate. It crushed the economy, but got inflation under control. And so the Arthur Burns warning is basically economic history saying you have to be very careful when you're trying to get inflation under control about lowering rates too soon. And so, we were talking about this. And, the Manheim used car index, which records used car prices, actually ticked up last month, and it was up 2.8% versus the prior month. Now, is 2.8% a big deal? No, but in a month, it's kind of significant. And one of the things we've talked about a lot here is we've had weak pricing on goods, particularly durable goods, and very high sticky prices and high sticky inflation on services. And so with continued services inflation, if that were to be joined by higher goods inflation, we've got a situation where everybody's convinced the Federal Reserve is going to cut rates in September. At this point, I think it's likely that they do. We've talked about that last week. We said our stance was moving from higher for longer to sooner rather than later on rate cuts. But this is a warning that they potentially could be making the Arthur Burns mistake and hiking into higher inflation. We're going to get a CPI report later this week. We'll see what it says. People are looking for 3%. Obviously, energy pricing is going to be a big part of it, but higher goods pricing could be a challenge for the Federal Reserve going forward.
So we're obviously expecting now, Gary, to the point we've shifted from higher for longer to sooner rather than later on those rate cuts expected to be in September. What does that number have to be, or what does that CPI increase have to look like for us to potentially bring back our favorite phrase? Well, I don't know about favorite, but higher for longer.
Right. Rob, it's a great question. And I think so what people are looking for on this week's report is a CPI of around 3%. And I think if they're around 2.9, 3, 3.1%, anything in that range, I think people will continue to expect a Fed rate cut in September. If you start to get like a monthly increase in like 0.3, 0.4, and you start to look at a CPI like in the 3.3, 3.4% range, like something a couple of tenths of a percent above expectations, I think in that situation, the market's going to get really nervous and take down the probability of a September rate cut. I still, I right now I'm sticking with where we were last week, which is the Fed is more likely than not to cut in September. I think the market thinks that for a reason at this point, but a hot CPI print and those expectations will change really quickly.
We'll keep you in tune. I'm sure we'll have updates on next week's 5 things. Gary, that CPI is this Thursday, I believe.
It's Wednesday or Thursday. I've got it in my calendar. I'll. I'll be up either way. I'm
Gary,
up by the time it comes out.
yeah, Gary will be reading the reports and listening to all the stuff so you don't have to, right?
Yeah, it's
That's
one of my favorite lines. You know, that they've put out like these 30-page press releases, and I always put in there like, for those of you who don't want to read 30-page economic reports, don't worry, we'll do it for you.
you got you covered.
Yeah.
Thanks, Gary. That's a wrap on this week's 5 things. As we mentioned at the top of the hour, be sure to consider a premium subscription as we have a new DKI position that we're teasing, going to be rolling out here in the next week or so, that we're really excited about and has a lot of tracking parallel to what we saw with Shockwave Medical, as I'm sure a lot of you are privy to back in December. As always, thank you for tuning in. Be sure to at least consider a free subscription or subscribe to us on our YouTube channel or any other social media. Gary's very active on X, Instagram as well. Variety of different mediums to get you the content and information that you want to keep you in tune with the market and what's happening. Gary, final thoughts for this week's version of the 5 things.
Yeah, a couple of them, Rob. One is on this show, we talk a lot about macroeconomics and the economy, and that stuff's interesting, and there's new news every week. But the core of what we do at Deep Knowledge Investing is we help people invest, and it's finding new ideas where we could make a multiple of our original investment in a multi-year period. That's really the thing that we get excited about. Talking about this stuff is fun, but what really energizes me is finding that next investment idea and the next opportunity to make great returns in a stock. And that's really what people come to Deep Knowledge Investing for. So if that's interesting to you, we'd love to have you. For everyone watching this, thank you so much. We've had some great subscriber growth recently. We've had a number of videos that got an increased number of views. We've had some where we've gotten a lot of comments. For everyone who's commented, whether you think I'm right or wrong or have your point of view, we love hearing from you. Thanks for engaging. Even if you disagree, just tell me why. Like, I love hearing from those guys. Or those people. But we really appreciate it. Your time is valuable, and the fact that more of you are spending it with us means a lot to me, and thank you. Rob, always love doing this with you. Thank you. For everyone, Rob and I, we were on the phone for, Saturday afternoon. We're both working over the weekends, trying to plan and prepare for this. And I know I said it before, but another round of applause for Alex and Andrew. A lot of times junior guys and interns don't get the credit they deserve. I just want everyone to know these guys are doing a fantastic job. The quality of their analysis and work is first rate. And we're excited to have them join us on camera every now and then. So, that's a long wrap up, Rob, but there's a lot to be grateful for this week.
No doubt about it. And Gary, likewise, I really enjoy and appreciate being a part of this and looking forward to many more 5 things shows here in the future. Gary, thanks so much for your time and looking forward to chatting with you next week.
All right. Sounds good, everyone. We'll see you next week. Thanks.